Welcome back to Alternative Investing with Mike. In this episode, we will explore whether the Chinese stocks are starting a new, sustainable bull market. If so, what's the one thing you have to do to participate in this bull market? Using the CSI 300 index as a proxy for the Chinese stock market, we can see the market has recovered sharply after the initial COVID-19 sell-off back in the first quarter and is currently up nearly 11% year-to-date. Many people believe that this is the beginning of a new bull market in China, very much like the bull market back in 2014-2015 period. The first question that we'd like to find an answer to is whether this bull market is sustainable. Will it continue? Unfortunately, we will never find a definitive answer to this question, but we can look at some of the contributing factors. I read some of the recent research reports produced by investment banks and brokers both inside and outside of China, in both English and in Chinese. Let's look at some of the highlights. On the plus side, leverage in terms of margin accounts, etc., are still much lower than the historical heights we have seen back in the 2015 bull market. Sector rotation in stocks have not been completed yet. The transition from hot sectors like technology, consumers to banking, real estate, and other cyclical sectors have just begun. The Chinese stock market has risen too fast in the last few weeks that many investors have not entered the market. At present, institutions and some experienced retail investors are invested in the market. But because the Chinese stock market is largely driven by retail investors, there is still a lot of incremental capital yet to enter the market. COVID-19 vaccine may come out by year-end. On the negative side, even though we do not get into politics on this channel, we all know that the US and China are in a Cold War. Much like the trade war, the consequences of a Cold War for both the Chinese and the US stock markets will be unpleasant at best. A large retail participation in the Chinese stock market makes it more volatile and vulnerable to sharp up and down moves. Investors are showing signs of irrational hysteria about the market, as shown in the quotes courtesy of Bloomberg. The vaccine for COVID-19 may not be developed by year-end. Given all these opposing factors affecting the market, will this bull market continue? We cannot give a definitive answer since no one can predict the future. You must arrive at your own conclusion. However, since I have been through the bull market in China back in 2014 and 2015, and knowing how momentum works in the Chinese market, I will participate in this bull market. For those of you who also decided to take advantage of this market, how do we actually participate? The key to a good investing or trading strategy is risk management. One thing you must do is to control your risk. I will introduce to you a very simple technique to invest and to control your maximum loss. We will buy the X-Trackers Harvest CSI 300 China A-Shares ETF ticker ASHR to participate in this assumed Chinese bull market. ASHR is the ETF that tracks the index. If you want to know more, please refer to the previous video where I highlighted the top 5 most useful ETFs for the Chinese stock market. Let's say our available fund for investing is $1 million. So how many shares of ASHR should we buy? First, we must decide on the maximum loss with this trade. This number is subjective to each investor's personal preference. For me, I will choose 1% of the capital. In other words, I want to lose no more than $10,000. That is my maximum loss. So how many shares of ASHR should I buy? It's not simply dividing $10,000 by the current price. because you will not and should not lose all your capital in any investment or trade. If ASHR has options, then this goal will be easier to achieve. But unfortunately, there are no listed options for this ETF. Then how do we manage this risk and size our investment? We can employ a strategy that can incorporate some of the features of a call option. This is achieved using a stop-loss order and the purchasing the number of shares that's inversely proportional to the volatility of the ETFs. We can use ASHR's last 20 days average true range calculated using open high-low close data as one form of the volatility. You can simply calculate the average of the difference between the daily highs and daily lows for the last 20 days. There are many websites that will tell you how to calculate ATRs. I will link to one of the websites in the notes below. ATR is one representation of the underlying volatility. This is a range the stock may normally fluctuate during a typical trading day. We will use 2 ATRs as our risk range so we can let the market move a bit and still be able to stay within our max loss. To calculate the number of shares to buy, we can compute the following: $10,000 divided by 2 ATRs. Therefore, we should buy 6,900 shares of ASHR. The 2 ATRs is also the price offset for our stop-loss order. In other words, let's say we bought our shares at $34 on the market open next day. Then our initial stop-loss order price will be 34 minus 2 ATRs. If anyone has questions regarding stop-loss order, please comment below. We could review that separately. Once we have our initial stop-loss order price, if the stock drops to that price, we will be out of our position and realize our targeted loss of $10,000, and this trade or investment is over. However, if the Chinese stock market keeps on going higher every day, we will move our stop-loss order higher relative to each day's closing price. This way, we can lock in some of the profit while still let the bull market run. The earning potential is nearly limitless, like a call option, while at any time, our max loss is only $10,000 away from the equity high reached at the end of the day each day. Please be aware, this is not a recommendation for you to buy or sell any security. It's simply an educational video to demonstrate one way to mitigate your investment risks. Thanks for watching, be safe, and be profitable. See you next time.